The long overdue gold price rebound has arrived. Leave stocks behind as the gold price shows strength. The time has come to consider unloading some stocks from your investment portfolios. As an alternative, it's time to reconsider gold, especially because the low gold price likely won't stay low for much longer. The current Dow Jones highs in the midst of domestic and international political uncertainty beg for prudence. Advertisement: consider taking a flight to quality of the kind established over millennia. Gold has been the asset of choice for jewelry and precious objects since 5,000 years ago, Mesopotamia, Egypt, and for coinage since 800 BCE, almost 3,000 years ago. Investors have forgotten about gold lately, given the megalomaniac equity markets. The all but expired course for cryptocurrencies, down by some 80% from their highs, and the abundance of risks and potholes that stocks are confronting mean the yellow metal is likely to rebound in popularity. The gold price is set to increase as fear grows, and the gold price has already started to reflect the gradual re-emergence of fear on Wall Street. It has not taken long for the gold price to re-establish a floor price of about $1,200 per ounce. Admittedly, the gold price chart does not inspire much confidence. Yet, consider it in the context of the obstacles gold has encountered over the past 3 years, that is, since Fed Chair Janet Yellen announced the gradual termination of quantitative easing in December 2015. The Fed's resumption of successive nominal interest rate hikes has penalized the gold price. Yet, investors, the financial media, and many analysts have chosen to discount the ghosts that continue to haunt the global economy and the markets exactly 10 years after the collapse of Lehman Brothers Holdings Incorporated on September 15, 2008. Simply put, despite the Wall Street records, there's a sense that many investors worry over the health of the financial markets. These fears are going to provide the necessary lift for the gold price to soar again. There's no denying that Wall Street and many of its global counterparts ended 2017 with a turbo boost and started 2018 with nitrous oxide. Stocks are defying odds, but circumstances are odd. Despite many concerns about political stability in the United States, the shadow of impeachment has plagued the Trump administration before it even formally began in January 2017. Stocks have seen a steady upturn. Euphoria and irrational exuberance, as Alan Greenspan described the gung-ho markets of the mid-1990s, have been the engines of Wall Street's performance far more than any convictions rooted in reason. But as anyone who's ever been young knows, every good party comes to an end. And not all ends are calm and smooth. Some are abrupt and come with a hangover. Apart from any side effects from too much partying, stocks have achieved such incredible valuations, and often for flimsy motives, not to mention aided by tax cuts and buybacks, that they're unable to surprise us any longer. In other words, stocks have gone so far up that, like the mythical Icarus who flew too close to the sun with wings of wax, they have become vulnerable to their own success. The Dow has resumed trading above 26,000 points. Still, high-profile stocks are showing considerable weakness. Tesla Inc., Nasdaq TSLA, for example, but Facebook, Incorporated, Nasdaq FB, as well. Thus, they have achieved such lofty valuations as to finally cause investors to pause, think, and ask important questions. The potential for setbacks is higher and the consequences more forbidding to ponder. A gold short squeeze. Though I'm not a big believer in chart patterns, some say seasonality has also caused the gold price to suffer. The argument suggests that, for the past 30 years or so, the best period for gold prices runs from September to December. That's certainly possible. But it's not necessary to rely on such tea-leaf reading approaches. The gold price will rise because logic is on its side now more than at any other time in the past few years. And, if you don't trust logic, trust the fact that short positions against gold have reached record levels. Source: Precious gold rises slightly as soft U.S. data tempers rate hike views. Reuters, September 12, 2018. Should gold's recovery, as many expect given a slight weakening of the U.S. dollar, continue, the short sellers including several hedge funds will face a squeeze, adding fuel to the rally. If the short squeeze fails to materialize, there are other factors that are shaping up in favor of the gold price. Trade tariffs and emerging market trouble boosting the gold price. The trade tariffs and sanctions against Iran, one of China's key oil suppliers, have triggered a rush to buy US dollars in several emerging economies. The related crises in Turkey and Argentina represent merely the two better-known such cases. The general phenomenon over the past summer has been one of worried investors in emerging economies and speculators exploiting the weaknesses buying up dollars. Evidently, this caused the US dollar to appreciate over other currencies and over gold. Russia faced this problem years ago and in an especially intense manner since 2014, when the Obama administration imposed sanctions over Moscow's absorption of Crimea. Moscow's solution was to gradually sell off its dollar reserves while acquiring huge amounts of physical gold. In the face of a trade war, China could retaliate by selling off US treasuries while increasing its gold reserves. Likewise, troubled emerging markets such as Turkey, Argentina, or even Venezuela may start to build up their own gold reserves as a shelter asset. Moreover, also in the face of a potential trade war, the very U.S. Federal Reserve Chair, Jerome Powell, may decide to put the brakes on the interest rate hikes, weakening the dollar. But while there's always the chance that Powell could reverse the interest hike, investors may interpret the move as an admission of economic weakness. That would also add support behind a potential gold price rally. The dollar's rise has doubtless impacted negatively on the gold price. For the time being, the dollar will remain the leading factor influencing gold prices. Indirectly, however, the dollar will suffer from the very factors that typically affect, and benefit, gold. Geopolitical risks have increased sharply, leading the world to the brink of various dangerous scenarios: Syria, Iran, and Russia, not to mention China and North Korea. The dollar will come under pressure, and even the European Union, frustrated by the inability to react to US dictates over where and with whom Europeans can conduct business, will look for ways to cut dollar dependency. A rally appears to be brewing, pushing the gold price toward and beyond $1,300 per ounce by the end of 2018. And the gold price could go far beyond that in the next few years. Nothing can hold gold prices back any longer. Change in Fed plans isn't only factor pushing for higher gold prices. Federal Reserve Chair Jerome Powell recently delivered some choice words at Jackson Hole, Wyoming. He signaled a reconsideration of the Fed's interest rate policy. Interest rates now may not increase as much as expected. That means a few things, but as far as investing in precious metals is concerned, it suggests that gold prices will start bouncing back faster than anyone expected. Unfortunately, some investors will simply use the revised, more dovish, interest rate trend to double down on higher risk investments like equities. They will follow the standard logic whereby lower interest rates will stimulate the markets. The indices will rise again, pushing stocks on Wall Street to new highs, perhaps surpassing the lofty heights achieved in January, with major upside technical violations carried out by the S&P 500 and the Nasdaq. Or perhaps not. Logic will return to the markets. Certainly, if logic returns to the markets, many stocks will collapse. At the same time, a return to logic would also boost safe haven investments. With the all but definitive depression in Bitcoin and cryptocurrency valuations, gold and precious metals will regain their top safe haven investment status and the price of gold will take a bullish turn. Admittedly, the chance of gold prices rising may still appear as science fiction. After all, conditions have been favorable to gold for some time now. And judging even by the latest gold rally, and its fizzling out, in August, even the most bullish of gold investors would find it difficult to remain optimistic. Indeed, the rising trade tensions between the United States and China, not to mention the ones between the US and Europe, and the ever more stressed geopolitical environment in general, the price of gold should have already gone up significantly. Instead, investors have not tripped over themselves to grab safe haven assets like gold or silver. The gold price has actually dropped, no matter how dire the effects of the 21st century version of the trade wars might be. More lurks behind the scenes of the latest stunted gold rally. At the time of this writing, the price of gold had just picked up by a few dollars after its latest failed rally. As the chart below shows, gold prices have dropped to their lowest point in a year. Yet the chart offers some encouraging hints. Notice that the recent gold price highs occurred in September 2017, March 2018, and April 2018. There's a common denominator. If there's one thing that has propped up gold, it's the threat of a conflict involving the Democratic People's Republic of Korea, North Korea for short. Yes, it's North Korea. In the past 365 days, the threat of conflict with North Korea was highest precisely when tensions between Washington, D.C. and Pyongyang intensified. President Donald Trump's meeting with North Korean leader Kim Jong-un last June may have lowered the chance of conflict. But it also caused a slump in gold prices. Behold! Not all is lost. The chance of conflict has just intensified again. Not only have tensions between the US and North Korea resumed, they are also more complicated. Perhaps in the midst of the Russiagate investigation and the passing of Senator John McCain, few seem to have noticed that President Trump has asked Secretary of State Mike Pompeo to cancel his planned visit to Pyongyang. China holds the cards. In keeping with the trade war theme, President Trump has blamed China for having failed to facilitate the peace process between North Korea and the United States. Beijing, admittedly, has no reason to cooperate with Washington, certainly now that Trump has shaken and stirred the principles of the World Trade Organization, WTO. The Chinese are sending a clear message to Trump: drop the trade tariffs and we shall cooperate with your North Korea plans. For all of Trump's ambitions and meetings with Kim Jong-un, prospects for peace in the Korean peninsula necessarily pass through Beijing. The People's Republic of China, in fact, has been the only country to have maintained close relations with North Korea. It's the only one that can broker a long-lasting agreement, or avert a war, for that matter. Yet, according to Trump's negotiation approach, whereby he pushes, even bluffs his adversaries into a corner, there's no turning back from the trade war. Or at least Trump won't back down ahead of the November midterm elections. A lot can happen between now and November. Trump must play to his base. He will therefore continue to use a strong hand against China while allowing the promise of better relations with North Korea go by the wayside. After all, he can always claim that he tried with the Singapore summit. Trump will also, given the political climate, continue to criticize higher interest rates and the related high US dollar. Encouraging signs for gold prices given the Federal Reserve's new reservations over its plan to further lift interest rates. Trump might score political points by conducting the kind of policies that will favor gold. Gold should begin a steady recovery over the next few months. Many institutional investors, hedge funds, and the like have held bearish positions on gold. Yet, a hiatus in the Fed's interest rate policy will force gold bears to wake up and smell the storm that's brewing over the equity markets. They will be encouraged to turn bullish on gold before it's too late. The US dollar has served as the main factor influencing traders' opinions, turning them against gold until now. A euro crisis. The gold price appears to be meeting resistance around the $1,215 per ounce mark. If North Korea, a trade war, and a suddenly bearish Federal Reserve aren't sufficiently convincing triggers for gold prices to bounce back, consider then the euro. One way or another, the euro and the eurozone could be stepping into a crisis. Italy has entered into a confrontation with the European Union over the migration crisis and the country's debt levels. Meanwhile, the European Central Bank, ECB, announced that it would stop quantitative easing in 2019. The latter move would reduce the strength of the US dollar while increasing tensions in the eurozone, prompting a rush to safe haven assets like gold. Moreover, there's the growing chance of a global recession that could not only stop the Federal Reserve from lifting interest rates, it could force the Fed to reduce them. That would happen just as the ECB hikes its own interest rates, reversing the dollar's gains over the euro. At that point, the gold bears will have no cards left to play.